workflow that I show you today is going to be back tested and shown live so that you can later on go and cross check our work and verify it as well. We are that confident with everything that we have created for you. Okay. So, having said that, are we ready to get started with day one of the Financial Freedom Accelerator? I want a FFA in the chat. Yes? Perfect. I will do my best. I'll try to simplify finance for all of you. I know it is something which everybody tends to overcomplicate, and it is not your fault. It is the fault of the professionals who are from this domain so that they can seem a little smarter. Okay. But I will be breaking that myth for all of you. Okay. I am nervous. Don't need to be nervous at all. We'll be starting absolutely from basics and let's try to learn it logically. Let's forget all the jargon and let's try to learn it logically. Okay. Perfect. Now, I got a question for all of you, and I want you to participate. And let's keep it very interactive between you and me. What matters the most for an amazing investment performance? Just talk about it from your experience, what you have heard, what you have had elders suggest to you. Okay, so I see money, absolutely important, consistency, gold, returns, compounding, knowledge, experience, ROI, discipline, candlesticks. Okay, solid expertise, discipline, patience, risk appetite, blue chip stocks, strategy. I haven't got my answer yet. Well, let me tell you, all of you, whatever you have said, you are right in your own sense, right? You are right in your own way, but I haven't still received the answer that I was looking for. And that answer is what we call as asset allocation. Now, all of you might be thinking, Are ye kya hai? Well, it is simply as the name suggests. What assets are you putting your money in? This is basically the first step that all of us we need to take before everything else that comes in that you have said, patience, ROI, discipline, strategy, knowledge, all of it comes later. Now think about it this way. If you are in charge or you're taking up a project of building a house, will you try and pick out the furnishings? Will you try and pick out the curtains first or the tiles first? Or will you first lay the foundations? You'll of course first lay the foundations, right? The base, the foundation, the pillar. Exactly similarly, that is what asset allocation plays, how it plays a part in our investing journey. So this is something that what we call as an investing pyramid. All of you know a pyramid, okay? Egypt. Now at the base of the pyramid, this is the foundation. What do we have over here? Asset allocation, right? Now, to simplify, what is an asset? Something, a financial instrument wherein you can put money. Now, this is the technical term. You know gold, it's an asset. You know stocks, it's an asset. You know land, it's an asset. Even the cash sitting in your wallet, that's an asset, right? Because it has monetary value. Anything that you can purchase or put your money in and it has monetary value that you can sell later on is what we call as an asset. So the first step that you decide is where to put your money, right? So for example, let's say it's your first job, you've started earning, you want to start investing, and you decide that gold and FD and land, all of it, I'll do later. But everybody is talking about stocks. I can invest in stocks very cheaply, or let's say mutual funds. I will do stocks. Okay? So that is your decision. You are deciding to invest in an asset which is called as stocks. All of you know what are stocks or shares? Reliance ka share, HDFC ka share, right? So that's an asset. Okay. So that is your first step. So you decide that I want to invest in stocks. Then comes the next step. Okay. If you want to invest in stocks, which stock do you invest in? This is what we call as security selection. Whether you want to invest in an Adani stock, a Reliance stock, an Infosys and TCS, or let's say Zomato, which is eternal, correct? Any stock, you are now deciding that I wanted to invest in stocks. Now I am deciding over here which stock I want to invest in, right? Ola, Vedanta, whatever, Paytm. So this step is what we call as security selection. Okay, you decided on an asset, then which particular asset are you going to go for within that category? Now, let's say all of you decide that we want to buy, let's say, Reliance. Okay, hypothetically, we want to buy Reliance. Then comes the last step, which is market timing. When do you want to buy Reliance? Do you want to buy it right now, or do you want to wait for a better price? Do you want to buy it later? You understand how we are going step by step up the pyramid, everybody? So this is what we call as the investing pyramid, and I'll be taking you through it step by step across the pyramid today itself. But first, let's start with asset allocation, okay, which is the first and the most important step, right? Now, let's say, for example, all of you have 100 rupees to invest. You have 100 rupees, you want to invest it, okay? Now, it can be such a case that you invest 60 rupees in stocks, 30 rupees in FDs, and 10 rupees you keep as cash. This can also be a simple asset allocation for somebody. Does that make sense? Okay, this can be a sort of allocation, asset allocation. Now, let's see what is the most important thing for us to be able to do asset allocation. You tell me. What's FD? Fixed deposits. What is the most important thing to understand where you want to allocate your asset? The first most important thing is to know what are the asset classes that we have at our disposal, right? If we don't know what asset classes we have, we can choose from. How will we choose? So the knowledge that we want to have is what are the asset classes available to us, retail investors, regular people who are putting their money in the investing their money, right? Now we have a lot of options. First is, of course, the cash sitting in your wallet. Now, tell me something. If you put a 500 rupees note in your wallet and you take out your wallet after 1 year, is it going to become 501? No, right? So all of us, we know that cash has zero growth, zero appreciation, zero returns. It is not growing. So hence the 0%. Value declines and all will come to that, Simiji. All right. So zero return. The next asset class that we have at our disposal is fixed deposits. Our parents loved it. Our grandparents loved it even more. You put in a certain amount of money and you keep getting interest. So fixed deposits, earlier it used to get a lot of returns during our grandparents' time, right? 13, 14, 15% returns. Nowadays, FDs give around 5 to 7%. Then we have something called as bonds or debt mutual funds. Again, it is like a fixed deposit. You put your money, give your money to somebody, right? It can be a bank, it can be a corporate entity like, let's say, Adani or Reliance. It can be to the government, it can be to the RBI, and they will give you interest. Very similar principle to a fixed deposit. So bonds and debt mutual funds, they give around 7 to 9%. Then we have gold. I think gold needs no introduction. Yes, gold has given a lot of returns over the last 2 years. It has corrected also recently, but that is exactly how gold moves. It does nothing for a long period of time, and then all of a sudden it will grow, and then again it will start doing nothing, right? So on average, gold has also given us 9 to 11% returns, right? This is the average annual return that you get investing in gold. Then we have something called as real estate. What is real estate? Ghar, bangla, makan. It is either the apartment that you're living in, or a piece of land that you hold, or if you have invested in a commercial property like an office space or a showroom, all of these, right? Land, built on land, is called as real estate. Now, real estate also, on average, it gives 7 to 9% return, correct? Not more than that. On average. Now, don't come and tell me, Arey, my Chacha ji had bought a plot of land for 50 lakhs. In 2 years, it became 1 crore. Right? Those are one-off scenarios. I'm talking on average. All the households, all the land that you see, on average, they grow at around 7 to 9% per annum, that too including the rental component. If you are putting it on rent, only then, right? What are REITs and all? I'll come to that. let's not overcomplicate at the beginning itself. Let's start keeping things simple, and then we'll move on step by step. Okay. So that is real estate. Then we have stocks, which we have already discussed. Now stocks, somebody will say, what is equity? It is the same thing. Stocks, equity, shares mean the same thing when it comes to the markets, right? We have different terms because we like to complicate people. We can simply say it's a share, or we can simply say it's a stock, but we like to call it equity sometimes. Okay. One and the same thing. Now there are mutual funds which have multiple stocks. So you have stocks, you can either invest in a single stock, or you can invest in a mutual fund which has a lot of stocks. Very, very simple. Now, stocks on average, the biggest companies, right, in our country, they on average have given us 12 to 15% return over the course of the last 20, 30 years, right? Then we have something called as cryptocurrency. Anybody who has not heard of cryptocurrency, you might not understand, but you would have heard of cryptocurrency. Bitcoin, yes? Everybody. Now, cryptocurrency also on average has given us good returns, around 15% on average. Okay? Digital assets, right? Now, what does cryptocurrency give you apart from returns? Any guesses? What is it that cryptocurrency gives you? Like returns to aapko de hi rahe hain, will give you something else also. Bad tax policies, huge volatility. Your cryptocurrency can double overnight. It can be zero also the next day. Risk, headache, and sleepless nights. Okay? That is one thing that you get with cryptocurrency as well. And last but not the least, we have something called as alternate assets. Now, what are alternate assets? Have you heard about people collecting paintings? Absolutely correct. Art, or let's say wine, expensive old liquor, alcohol, right? Watches, coins, right? Nowadays, shoes as well, right? Antiques, shoes and bags. Now, these are what we call as alternate assets. There are not real marketplaces for this in terms of we don't have a stock market like exchange for this, but there are offline marketplaces, or let's say mediator run marketplaces. Now, even alternate assets, right? They give a lot of returns. They give around 8 to 10% returns on average. But what is the problem with alternate assets? Any guesses? They have auctions, correct? Any guesses? It is not regulated, first and foremost. There is a lot of risk and what we call as price discovery. If you, let's say, want to buy a share of Reliance today, you can just go check the price of Reliance. You'll be able to buy at that price. You'll be able to sell at that price. You know exactly what the price is. But if you, let's say, take a watch to somebody, he'll say, "Arey, sir, there is a lot of supply of these watches. We will not be able to give too much price." That same person, when they goes to somebody to sell it, they'll say, "This is one in a million, right? You will not get another piece," and sell it at 100 times as much. So there is no transparency. And the thing is, if you're somebody who is not from this industry, or you are not a veteran, you will get absolutely crushed. When you're trying to sell, you'll get zero value. When you're trying to buy, you'll be absolutely ripped apart. Because that is how there is no price discovery mechanism. We don't know what is the actual value of a painting. Somebody will say, Vaibhav Leonardo, or Vaibhav da Vinci created this painting. And you're like, oh, Vaibhav da Vinci, Arey, who is he? They'll just put in a sign and say, this is valued at $1 million. So you don't really know what is going to happen, right? So having said that, 5 asset classes go out of the door itself. Cash because no return, crypto because very risky and volatile, alternate assets very difficult for regular people to actually survive in this domain. So we are left with only 5. Can I have in the 5 in the chat if we are absolutely clear? We're left with only 5. Now we'll come back to this 5. Okay, we'll need to see, okay, which of these 5 works out for us. We'll come back to this 5. But in the meantime, let's take a little detour. Okay, let's take a side street. Let's talk about something called as inflation, which I like to call as the unfactored nightmare. And it's a nightmare that everybody faces or everybody has to go through, even if they don't realize it. Now, inflation is what? Anybody? It is the phenomena of prices increasing, or what we call in simple Hindi as mehengai. For example, what is the price of potato today? Anybody, can you educate me? It's near about 45 rupees, if I'm not wrong. Somebody saying 25, but I believe, so I stay in Calcutta, I believe it's around 45 rupees, right? Now, 5 years back, the price of potato was around 17, 18 kgs, 17, 18 rupees a kg. Do you think the potato has evolved? It is tastier, right? It will do your household chores for you. No, it is the same old potato as 5 years back. What has happened? Only the price is increased. And this is what happens. Prices tend to increase with no additional value to the product. Correct? Same. Anything else? Earlier, you could buy a decent mid-range smartphone for the price of 10, 15,000 rupees. Nowadays, the concept of mid-range smartphone matlab 50, 60,000 rupees. Yes or no? Right? So again, everything tends to increase. A good laptop nowadays, 1 lakh rupees. Earlier, I know when I was in school and college rather, I bought a very, very good laptop for 30,000 rupees. Yes, absolutely. And this is what, 10 years back. And nowadays, you will not get a decent, good laptop for less than 1 lakh rupees. So everything tends to increase with price. Now, the government also has a way of telling you how much prices are increasing. So the government has something called as the CPI figure, which they call as the Consumer Price Index. They use this figure to calculate the average inflation in the country. Now, on average, historically, the inflation figure or the CPI figure has been around 5%. It was lower recently. It tends to be higher sometimes, but on average, it is safe to say that the inflation figure that we have been experienced for the last decade or so is near about 5% on average. But do you really agree that your expenses have only increased by 5%? Somebody says, hell no. Well, let's do a reality check. Okay, very, very basic necessities, something like food, it is increasing at 10.4%. Something like medicine and hospitality, right? Hospitals, right? 14%. Education, 11.5%. Rent, 16%. Especially in tier 1 cities, it is even more. Now, for a fact, I know that before COVID, I used to stay in Bangalore. The rent in Sarjapur was around 30,000 rupees. You could get a 2 BHK a decent 2 BHK. Nowadays, my friend still recently shifted to Sarjapur. He could not get a decent 2 BHK for 60,000 also. Right? And it has not even been 5 years. So, and these are all important things, right? These are not luxury or, irrelevant expenses. These are some things that everybody needs to incur. And that is why we have another metric called as the cost of living, which actually tracks how much our expenses are increasing on a day-to-day basis. That metric is 8.4% from 2016 to 2025. Over the last 10 years, it has been 8.4%. That means if something was costing you 10,000 rupees 10 years back, today it will cost you that very same thing without any changes whatsoever, 22,402. Almost double. Okay? Now, why are we talking about inflation? Any guesses? Any guesses? Absolutely correct. Some of you absolutely understood the reason. Now, our expenses are increasing by 8.4% minimum, yes or no? Let's try and understand this very simply. Expenses are increasing 8.4%. Our money at the very least needs to grow by 8.4% to maintain the same standard of living. Yes or no? Everybody? Expenses are increasing 8.4%. Our money needs to grow by 8.4% to at least maintain the same standard of living. Now let's go back to our example. Correct? There is, let's say you have an investment option which is giving you 10% return, right? Your money is going 10%, but expenses are also growing 8.4%. No. So how much are you actually growing your money effectively by? 1.6%, 10% minus 8.4, 1.6%. That is what we call as the real return, or in technical terms, inflation adjusted return. In reality, if you're earning 10%, you're actually earning 1.6% of true appreciation or true gain. Is this concept understood by all? Very, very simple. Expenses increasing 8.4%. Your return needs to increase by more than that for you to actually see observable growth. Understood? Now let's go back to the 5 other asset classes that we had. We had FDs. FDs give between 5 and 7% return. Is it good for growth perspective? Less than 8.4 does not make sense. You're actually losing money, as somebody earlier on had predicted. What about bonds, debt, or real estate? Everything is giving less than 8% return on average. Again, same problem. Doesn't work. What about gold? Yes, gold on average gives 10-11%. Okay. So you're making what? 1.5% of real return, 10%, let's say average gold growth per year, 8.4% is your cost of living at the very least. So yes, you're not losing money, but it is hardly any growth, right? 1.5%, absolutely correct. Not much of true growth. So that is also out of the question. And what else do we have? Then we have stocks. Now, even the biggest stocks, which are slow moving or they don't give too much growth, even they have given 13.2% on average, which is approximately 5% of real growth. Right? So they end up being the only viable option that we have. Now, do you see? First, we did a methodological cancellation of these 3. Then we understood inflation, how it plays into our lives, and then we were able to eliminate all of these as well. Why? Because our objective is to achieve growth. Does that make sense? Yes? Perfect. Everybody clear till now? So we understood that in terms of asset classes, if we're looking for growth, stocks, hands down, safest and the best way to go forward. Let's take another detour and learn another concept. Okay. This a lot of you might be knowing, but still for the benefit of everybody else, let's do this. Okay. The next thing that we want to understand is what is the best asset allocation strategy. We have learned the best asset class. Now let's learn the best asset allocation strategy. Okay. I want all of you to do this analysis with me. Okay. All of you, can you put in an analyst in the chat? I want all of you to act as analysts. By the way, guys, I missed out on saying something. Take notes wherever you feel it is important. I'll be sharing all the materials at the end of the session today for today's agenda. And at the end of day 4, we will be sending a consolidated list of all the things that we have taught you. So you'll get a detailed notes by the end of day 4 as well. Okay. Now, coming back, as all of you are ready to, work as analysts, let's look at an analysis that was done by one of a very, very good analytics company in India, which is called as Capital Mind. Okay. Now, they did this analysis And this was between 1990 to 2020. So they looked at data from 1990 to 2020, and they looked at four securities. Okay. One was the Nifty 50 index ETF. Okay. Don't complicate what is ETF, what is Nifty 50 index. Top 50 Indian stocks, biggest 50 Indian stocks. Nifty 50 across this 30-year period gave 14.4% returns per annum. That means on average. Okay. Fixed deposits across the 30-year period got 8.9%. Gold across a 30-year period gave 9.5%. And N100, which is basically what we call as NASDAQ 100. Like we have Nifty in India, NASDAQ is an exchange in the US, which is basically for the tech stocks. And there is an index called as NASDAQ 100, the top 100 tech companies in the US. Okay. So the top 100 tech companies in the US, the Google, Alphabet, everything that Apple, Tesla, Meta, all of these are a part of the tech industry in the US. They're a part of the NASDAQ 100 as well, right? So this is the NASDAQ 100 ETF, and that gave 13.3% returns on average across this 30-year period. Okay. Now, I have a question for all of you. You have seen the returns, right? Now, if I ask all of you to tell me one thing, if you are, let's say, all of you are analysts, you are working with clients, the client comes and tells you that I need to invest some money, and you have the option to choose, let's say, go back in time and choose. Would you choose to entirely invest that money in Nifty 50, or rather split it in equal parts across all four? Nifty 50 only, या फिर all four? Tell me. Drop in Nifty if you believe this is the best way. Drop in equal if you believe this is the best way. Nifty, equal. I'm getting a lot of equal, but why do you think majority of you are saying equal? I'm getting a lot of Nifties as well, but I think more people are saying equal. Are you trying to, be smart and assume that, arey, Nifty to will be very straightforward? Rahul sir will not ask such a simple question. It should be equal. Is that the reason? Let's see. Okay. Okay. So Capital Mind already did this analysis. Okay. And you will learn something new from this. Let's look at the actual outcome. Can all of you see my chart? So this is the returns distribution. In the last year of the analysis, what was the last year? 2020. Okay. The equal portfolio gave 18.3% return, whereas the Nifty gave 14.2. Any guesses why? What happened in 2020? COVID. So, one-off situation. Maybe because of COVID, one-off situation. Let's look at the last 3 years, 2018 to 2020. Equal gave 12.6, Nifty gave 3.2 on average. Last 5 years, Equal still gave more, 2016 to 2020, 11.9 versus 6.5. Last 10 years, 2011 to 2020, 12.7 versus 8.7. 15 years, 2006 to 2020, 15.1 versus 12.7. Surprising, isn't it? That even though Nifty had the highest return on average, this is how the actually turned out in practice from a practical standpoint. Now look at this graph as well. The green one is the equal portfolio. The gray one is the Nifty portfolio. Just looking at these two graphs, what do you think is the difference between these two? Simple. You don't need to know anything. Just tell me the characteristic of the graph. Steady. Green is more steady. Now, what are we plotting over here? Price. This is time. This is price. So if that means price is steady, and over here in the gray one, the price is moving up, down too much. Correct? Now tell me something. Do you want a lot of fluctuation in price, or do you want a smooth price movement? You want it to be smooth, right? Too much fluctuation मतलब tension. अरे नीचे गिर गया, अरे ऊपर बढ़ गया. Tension and ecstasy. Tension and ecstasy. Now, this is exactly what we call in statistical terms as volatility, right? And volatility in a little more market nuanced aspect is what we call as risk. So if the curve is stable, that means less risk. If the curve is very going up and down, very much volatile, that is what we call as high risk. So not only we learn two things, not only is the equal portfolio giving higher returns, it is also giving you less risk. And that is exactly what we learn from this analysis. This is what we call as diversification, as a lot of you have been telling me in the chat. Absolutely correct. Never to put all of your eggs in one basket, right? Equal, that means a lot of securities, you have all four. It generates better profits over the long term. We have seen it protects against market downturns or black swan events. What is black swan event? Something like a COVID, something nobody could have expected, right? And it also gives you peace of mind because it is a smooth, less volatile movement. So have we understood the importance of diversification, everybody? Never to put all your eggs in one basket. Now, you might be thinking that why did we learn of diversification all of a sudden, right? I want to ask you a question and you tell me now. Now that you have seen asset allocation, inflation, and diversification, how should we build our own investment portfolio which is diversified and has growth potential? What have you learned till now? Yes, stocks, because that is the only one which makes sense when considering inflation. But we also need to diversify. So the solution is multiple stocks. Everybody clear with this? Because of inflation, stocks stand out, but we can't invest in just one single stock. We have to diversify across multiple different stocks. Everybody clear? This is exactly what we call as diversification or having a diversified stock portfolio. Now tell me something till now. Are we going absolutely fine? Everybody understanding everything? Am I able to make things simple enough for you? We need to understand this simple concept so that we can understand the strategies better. Okay. Now, the next question all of you will be having is, okay, that is great, sir, multiple stocks, but how should we begin our diversified growth investments? Very, very natural question. And the simplest way that you can do that is something what we all know. Index mutual funds. How many of you don't know what an index mutual fund is? Don't get scared by the name. So that's a lot of you. Okay. So let's try and understand what index mutual funds are. Okay. For those of you who do know, just, wait for 5 minutes. Maybe you will understand a different aspect of, learning about mutual funds. Okay, everybody, now I want your focus back on me. No more chats. And let's try and understand because a lot of you don't know what index mutual funds are. Okay? Focus on the screen. As the name suggests, the name index mutual funds, you know by now that there are two components to this name. One is an index, and then, of course, something that all of you have heard of is mutual funds. So we need to understand both these things first. Let's first understand what a mutual fund is. Okay? Okay? Now, think about it this way. Okay? Forget everything that you know or you have partially understood about mutual funds. How many of you, okay, let's have a little bit of fun. How many of you have ever had a mama, chacha, somebody else and come in and tell you, you know what, there is this dost who told me that over there in the suburbs, you have a piece of land which has very good potential. 5 years mein paisa double. We have all had somebody tell us this flat, yeah, this apartment, yeah, this piece of land. Yes. Okay. Okay. So this happens to us. Then you indulge. You decide that, okay, let me hear him out. So you say, okay, theek hai, tell me more about it. Plot prices 1 crore rupees. In 5 years, it will become 2 crores. There is a lot of development happening. Highways being created, mall is being created, schools are being created, offices are being created. Guarantee 5 years, paisa double. All heard this. Still, you decide to indulge, but 1 CR is a big price. To make a gamble, 1 CR is a big price. You don't, and it's a lot of money that you want to put in. Correct? Now think about it this way. You don't want to put in 1 CR, but you want to take an opportunity that if it actually works out, you're doubling in your money in 2 years. So what you do is you find 100 other people like this. Okay. You find 100 other people like yourself, and all of you put in 1 lakh rupee. Do you have 1 CR in total? Yes. Can all 100 of you together buy that plot of land? Yes. So all of you have 1% ownership. If all 100 people putting 1 lakh rupee, everybody has 1% ownership. Yes. Now, all of you put in your money together. Now you go and actually visit that place and you see that there are so many such plots of land. All of these plots are 1 CR rupees. Are you a real estate expert? No. But now all of you, you need to decide which plot of land that you actually need to buy, should be a good buy. So what you do is you hire somebody who is a real estate expert, and you say that, you know what, we don't know much about it, how the value is going to appreciate. And the real estate expert says, you know, it has to be a corner plot, it has to be near the highway, this, that, all of it. Don't worry, I'll decide which is the best plot for all of you to put your 1 CR in, right? Because he's the real estate expert. So you put your money together, you hire an expert, the expert picks out a 1 CR piece of land, right? And then you invest in it. And surprisingly, it actually works out. After 5 years, that 1 CR land becomes 2 CR. Your 1 lakh rupee becomes 2 lakh rupees. You give a small percentage to the expert for his advisory, let's say 0.5% or something, and you keep the rest. So what is exactly happening? This is what we call as the pooling of money, right? And hence the fund is called as a pooled fund, because all 100 of you are pooling in your money together, and then that money together is being, invested via an expert. Everybody understood the concept of pooled funds? Yes. Forget everything else. Pooled funds, you understood? Now, let me zoom in. You have pooled funds and you have expert. Okay. If that expert is a stock market expert who only invests in stocks, that pooled fund becomes a equity mutual fund or a stock mutual fund. Got it? Okay. If the manager or the expert is an expert on debt or bonds, that pooled fund becomes a debt mutual fund. If that expert, like in our example, is a real estate expert, then that pooled fund becomes a real estate mutual fund or a REIT, real estate investment trust. Some of you were asking what is an REIT? So that is how it becomes. If the fund expert, right, has an expertise on both stocks and bonds and puts your money in both stocks and bonds, it becomes a hybrid mutual fund. Do you see how simple it is? The concept is the same. A lot of people pooling in their money together, one expert investing that money, and that is how your money is being invested in the market. Depending on what asset you are actually going for, if it is invested in stocks, it becomes an equity mutual fund or a stock mutual fund. If it is invested in bonds, it becomes a bond mutual fund or a debt mutual fund. If it is invested in real estate, it becomes a real estate mutual fund. And if it is invested in multiple things, it becomes a hybrid mutual fund. Got it? Now, is it clear? Now, of course, there are further sub classifications and everything. We don't need to go into that. But now, what I set out to explain to all of you, what is a mutual fund? Now, do you know what is a mutual fund? And our core focus for today is going to be this thing: equity mutual fund or stock mutual fund. Got it? Because we are only focusing on stocks. Now, the next thing that we need to understand, remember, we are trying to understand index mutual funds. The next thing that we want to understand is what is an index. Now, tell me something. If somebody asks you, how is the AI industry doing? What will you say? Do you know each and every AI company and how the AI company is doing? Will you know that? Of course, no. So how do you tell that the AI industry is doing good? You will look at Gemini, you will look at ChatGPT, you will look at Claude, you will look at Emergent, all of these, a handful of names. You know they're doing very well, they're getting more and more users. So you only take the big names and you say, yes, AI industry is doing good. Yes or no? Do you know some AI company? You know, there are hundreds of AI companies in China, if not thousands. Do you know them? No. They are part of the industry as well, but you don't know them. Correct? So what are we doing? We are basically, when we're talking about an industry, we are only referring to the biggest few names. If they are doing good, industry is doing good. If they are doing bad, industry is doing bad. We're not thinking about all the other participants in the industries. So, like Kajal is saying, flagship companies, correct? This is what we call as benchmarking as well. Now, think about the stock market in the very same way, correct? If how many stocks are there in the market? Anybody, any guesses? How many companies are listed and you can buy and sell them? More than 6,700. Okay. More than 6,000, 7,000. Yeah, 7,000 approx. Okay. Across NSE and BSE. Now, if I ask you how is the stock market doing, are you going to look at all 7,000 stocks to give me an answer? No. You will take only the biggest few and see how the biggest stocks are doing. Okay. And then you will decide. That is exactly what an index is. An index is a hypothetical, okay, or an imaginary construction of a few select stocks, which we use to refer to a particular market. For example, we have something called as a Nifty 50, right? Nifty 50 is basically the biggest 50 companies in India which trade on the National Stock Exchange. So the Nifty 50 becomes a benchmark for the overall stock market in our country. Similarly, like we have the National Stock Exchange, we have the Bombay Stock Exchange as well. And it has a separate index called as a Sensex, which factors only the top 30 companies in the country. Okay. So Nifty 50 is the biggest 50 companies. Sensex is the biggest 30 companies. Why do we need this? These are, of course, hypothetical baskets, right? But why do we need this? So that we can tell you our overall estimation as to how the market is doing. Because as I said, it becomes very difficult to track 7,000 approximate stocks. Got it? So if I ask you today that how is the market doing, you will just quickly go and check Nifty, is it up or down? Or you will go and check Sensex to see if it is up or down. Got it? Yes. Now, like this, there are other indices. There are indices which are focused only on IT stocks, only on pharma stocks, only on banking stocks. So you can create different baskets that are there, and you can refer to them to identify that particular market. Correct? Now, all of you know what indexes are, or as we call it, indices. Yes, they are representations. Now, then what is an index mutual fund then? Now, what did I say? A very important thing about the indices. They are hypothetical baskets, right? They're only meant for tracking purposes. There is no way via which you can directly invest in Nifty 50. For that, you will need to buy all 50 stocks, right? That is wherein these index mutual funds come in. Mutual fund mein you can put in money and that fund manager will put that money in the stocks. Now imagine that you're putting in money and the mutual fund manager is only putting in money in the Nifty 50 companies. Then it becomes a Nifty 50 mutual fund. Got it? Right? Let's say the fund manager is only putting, just mimicking the Sensex, and all of you can invest in that mutual fund. It becomes a Sensex mutual fund. And these are what we call as index mutual funds. Very, very simple. Now there are ETFs as well. You have the Nifty 50 ETF, you have the Sensex ETFs, one and the same thing. Okay, let's not overcomplicate. They operate the same way. We have mutual funds which basically just mimic the top 50 companies or the top 30 companies. Got it? And we can invest in it. So we will be focusing on Nifty 50, which is the most commonly accepted and the most used benchmark, right? So we will be learning about the Nifty 50 like never before. Okay. Now Nifty 50 looks something like this. Top 50 companies, the top 10 in Nifty 50 can be something like this: HDFC, ICICI, so on and so forth. Now Nifty 50, which is the biggest 50 companies in our country, right? Over the last 26 years has given annual returns like this. How many times has it gone red? 1, 2, 3, 4, 5. 5 years out of 26 years, it closed in red. And that means 21 years, it has always turned out to be positive. On average, it has given around 11.5% every year. This is, I'm talking about Nifty 50, the biggest 50 companies, which are usually slow moving. Okay. Is it good? Nifty 50 has given 11.5% returns on average across the last 26 years. It's great, right? How many of you think it is enough though? Is it enough? No. Some of you are saying yes. You know what? Let's use the mutual fund Sahi Hai calculators to see if it is actually enough. All right. Let's see. So all of us, we know mutual fund Sahi Hai, right? All these calculators. Okay, let's see. Let's do an example. If you put 25,000 every month as an SIP, invested for 11.5% that Nifty has been giving, right? On average, and you do this for 30 years, you will have 6.97 crores. And after that, of course, you'll have inflation as well. Is it good? 11.5%. People are saying yes, people are saying no. Right? Now let's do one thing. What if instead of 11.5, you were able to generate 4% more? What do I mean by that? 15.5. How much does it become, guys? How much does it become? 15.58 crores. From 6, which is approximately 7 CR, to approximately 16 CR. And that, my friends, this is good enough. Huh? Everybody is now saying this is good. Now that, my friends, is just a difference of 4% annually, right? Just a 4% difference can make more than double, right? This is the power of compounding, and we'll be learning more about this. Now, I want to tell you something, right? Would you be happy if you could learn trading and investing frameworks that can help you potentially achieve this additional 4%, a little bit more? Because you have seen the difference, right? Yes. Well, what if I told you that we will share some of our best kept logical frameworks that have given backtested returns of 14%, 29.15%, 33%, 21.9% annually, all of them one by one today? Is that something you would be absolutely excited for? Yes? Well, without any further ado, there goes our theory part for the day. I hope we have learned a lot of new things, but now let's get down. Remember 3, 2, 1. So here we have, let's kickstart with the first segment of the practical part of the session today, which is 3 investing strategies that you can start using today. And why did we talk about Nifty 50 and index mutual funds? That is basically what the first framework is all about, which is what I call as the Nifty
प्लेट
EQ
हलो
SIP framework. Now, again, do we want to be people who blindly
পরে
follow a
ফোন করবো
framework,
বুঝলে
or do we want to be
আপনার
people who
ওই তো
understands a
বলার
framework and then implements it? We want to be people who understand stuff, right? So let's understand the framework first, then I'll show you the implementation. Now, remember I was started teaching you about Nifty 50, right? And this is exactly how Nifty 50 looks like, right? So 50 companies in Nifty 50. Now, if I look at the top 10 out of this 50, there is a certain weightage. HDFC Bank is 10.52%, ICICI is 8.32, Reliance is 8.27, Bharti Airtel 5.2, Larsen & Toubro 4.3. Now, what is this weight? It tells you exactly how much HDFC Bank is as a percentage of total Nifty 50. Now, just imagine one HDFC Bank makes up more than 10% of Nifty 50, which has 50 stocks, right? It is given that much importance or weightage in the index. Now, the next question that all of you, yes, absolutely correct. The questions have already come in, and it is the exact right question. That how are these weights decided? The answer is something which is very, very simple. What we call as free float market cap. Now, again, don't get scared by the name. Let me explain in simple English how the weightages are decided. Okay? Everybody, simple math. Let's forget about Nifty 50, okay? Let's think about an index called Nifty 2. Only two stocks in that index. Everybody, can I have a Nifty 2 in the chat? We are shifting our focus to something called as Nifty 2. Only two stocks in the index, Company A and Company B. Now tell me something. Company A has 7 lakh shares in the market, and the price of every share is 10 rupees. Company B has 2 lakh shares in the market, and the price of every share is 15 rupees. Okay. Now, what is the value of Company A's shares in the market? 70 lakh, 7 lakh shares into 10 rupees per share. What is the value of Company B in the market? 2 lakh shares, 15 rupees, 2 into 15, 30 lakh. Correct? What is the total value of the Nifty 2 index? 70 lakh plus 30 lakh, which is 100 lakh, or what do we know as 1 crore. Everybody understood how we calculated the value of Nifty 2? Just adding the total value of both the companies, right? See over here, Company A has more value, so it makes up 70% of Nifty, right? 70 lakh divided by 1 crore is 70%. Company B value is 30 lakh, right? Total Nifty 2 value is 1 CR, so it becomes 30%. So Company A has 70% weightage, Company B has 30% weightage. Everybody clear till here? How we are calculating the weightage of a particular company? Same thing happens. Nifty 50 is the sum total of the values of the 50 biggest companies. Now, HDFC itself is more than, the value of HDFC is 10% of the total Nifty 50 value. Now you understood how these weightages are defined? Everybody, value of HDFC Bank by value of total Nifty 50 stocks. That is 10%, right? Now, tell me something. Does this seem fair? There are 50 stocks, but only one stock has 10% weightage. As a matter of fact, can you tell me what is the combined percentage of all stocks? The top 10? The top 10 make up how much? Do a quick math. 10 plus 8 plus 8, that is 26, 27, 32, 36, 30, 40, almost 50%. Almost 50% of Nifty 50 is made up of the top 10 stocks itself. Does it sound fair? Does it sound like a true representation of the index? Well, there are problems wherein a few giants are running the show. Even within Nifty 50, which is supposed to be the top 50 companies in the country out of 7,000 stocks, even there is, disparity over here. Now, if we just look at Nifty 50, a few stocks are controlling everything. There is a hidden lack of variety. What do I mean by variety? I'll tell you one more fact. In Nifty 50, 35% stocks are banking, 17% stocks are IT, 52% stocks are only belonging to two sectors, and there are more than 32 sectors. Do you think Nifty 50 is meant to be a representation of our markets, right? Do you think if more than 50% is only in two sectors, it is a true representation? Or if 10 companies have more than 50% weight, it is a true representation? No, right? A handful of big names decide the whole index's fate. And of course, the relatively smaller companies, let's say 25 to 50 onwards, even if they're doing good, it will not really reflect in Nifty too much because their weightage is small. Correct? Makes sense? Let's say, by the way, the bottom five, rank 46, 47, 48, 49, 50, the bottom five only make up 1.8% of Nifty. So let's say the bottom five start doing very good. Nifty will not move. So that means it is not a true representation. So what is the solution over here? Any guesses? If you had to correct this weighted system, what would you do? Being an absolutely impartial person. Absolutely correct. I got the who gave the right answer first? My chat box keeps on scrolling. It was Venkataji. Equal distribution. Hemraji also. Equal weight. And that is exactly what the solution is. Prioritize every stock equally. Right? And this is ideally what we're looking for. If there are 50 companies, give 2% weightage to each. Right? Such that there is each and every stock matters equally. The risk is spread evenly across sectors. And even if the smaller, relatively smaller stocks do well, Nifty still gets to see the benefit. Right? Okay. Does this look fair enough for you? Is this fair enough? Well, would you love to see what if one invested in Nifty 50 equal versus Nifty 50? As an investor, fair, unfair, to chalo theek hai, baat ka baat hai. As an investor, does the Nifty equal makes more sense? Would you like to see the returns? Yes? Let's see if fair is good for an investor as well. So let me show you something. This is a Nifty 50 equal weight index mutual fund, right? And can you see the last 5 years only? Across the last 5 years itself, how much has the equal fund given? Nifty 50 equal given 14.11%. How much has Nifty given across the last 5 years? 9%. Same Nifty 50, just weightages are different. Can you see the difference? Yes? Can you see that over here? That's same Nifty 50, more than 5% difference over half a decade. Right? How many of you invest in Nifty 50 mutual funds, by the way? Let me see the painful me's in the chat. People are putting in me's with tears in their eyes, is it? That's so many people. You might be thinking, Are, sir, are there Nifty 50 mutual funds with equal weight? Absolutely, yes. Like I showed you, there are so many more other funds who have their Nifty 50 equal weight mutual funds as well. I did not develop a solution for you over here. The first strategy, it is not even a strategy. It is only knowledge. Just knowing the right sort of Nifty fund is enough. But how many of you have never heard of this? Nifty 50 equal funds, right? Would you like to see all of you who have been investing in Nifty 50 mutual funds, right? If you had invested in the Nifty 50 equal weighted mutual fund, would you like to see what the difference would have been? Let's do another example. Let's say all of you are doing a 10,000 rupee SIP, annual step up 10%, expected return. Okay? Expected return is how much? 9%, right? Nifty 50 gave 9% only last 5 years. And you do this for 25 years. You would end up having 2.78 crores. If you, right? If the same thing, for example, hypothetically, let's assume that the same thing continues in the future as well. You will end up making 2.78 crores. But no matter how the market is performing, if the Nifty 50 equal performs as it is, again, that also being the same, on the flip side, you would have made almost double 5.1 CR. How many of you, those who were having tears in their eyes, did I make the pain even more difficult to digest? So again, it is not something which is too smart. It is not something I invented, but it is knowledge that you will not find influencers talking about or YouTubers talking about. This is very, very simple knowledge. And as a matter of fact, how many of you would love to know another shocking truth? Empirically, okay? Empirically, what does empirically mean? That means by actual studies conducted, it has been seen that majority of the time, equal weighted indexes outperform market weighted indexes. And still, we see people doing what? Nifty 50 rather than equal weighted. You can go and check this yourself. How many of you learned something new? Yes, mutual funds, do your SIPs. I know it is very, very seamless, easy to do, but do it smart. We were looking for 4% difference. I showed you the simplest of things and it has generated more than 5% difference. Yes or no? Yes. So learn and look into equal weighted index mutual funds. Yes, all of you who are doing your SIPs, I think it's time for you to do a sense check. For people who haven't yet started, very, very good way to start investing small amounts, a smarter way than most people do. Okay. Now, would you agree that the Nifty 50, even with the equal weighted method that I showed you, is the best way to make money from the markets? What do you think? Maybe, yes, no. Well, the answer is no. It is okay for passive investing. What do I mean by passive investing? What does passive mean? Doing nothing, right? Passive matlab doing nothing, right? So when you are doing mutual fund SIPs, let's say a Nifty 50 equal SIP, you are setting up your SIP once and that's it. Every month automatically bank accounts the money will be deducted and it will be invested in the Nifty 50 equal ETF or the Nifty 50 equal mutual fund. Are you doing anything? No. Are you taking decision? Wait, what do I buy? When do I buy? How much do I buy? No. You are taking the decision one, I'll do an SIP of let's say 5,000 rupees every month. That's it. This is a passive way of investing. It is good. I also do it. But is it the best way? No. It is okay for passive investing over the long term, but active investing. What does active mean? Active means you are doing stuff, right? You are deciding what to buy, when to buy, how much to buy, when to exit, when to sell. All of this is getting actively involved in the investing process. Now, active investing, if done with discipline, risk management, sound process, has a very, very good potential to generate better returns than passive investing or index investing. Okay? So the next question all of you are going to ask me, Rahul sir, great. How do we get into active investing? Well, the simplest way is to take our dear friend Nifty 50 and show you the second strategy that I want to teach you. And I'll be using Nifty 50 for this also. Because we have already made a friend, let's leverage our friend. So introducing the second framework to all of you, which is what I call as the SpringPads Nifty 50 rebalance template. Okay. Okay. Everybody ready? Let's see if we can be smart and methodical with active investing too. Okay. Now, how many of you think that active investing requires you to be active every day, every minute of your being? Anybody? Well, that is not the case. Let me take you through this framework and you will understand it. Okay. So we will be understanding the strategy first and then implementing. Okay. So Nifty 50. Now, every year, Nifty 50 is rebalanced. Okay. What do I mean by that? Let's say in your school, did the top 3 students always remain the same? Every exam, you had the same 3 students who were the rankers? No, right? It kept on changing. Correct? So do you think the top 50 companies should be constant or should it also change? Companies which are getting bigger, which are performing better, they should be a part of the top 50. Companies which are not doing that well, they should get kicked out, right? Correct? Same thing happens with Nifty 50 as well. The top 50 is not a constant figure. It keeps on changing. Who decides? So there is a separate committee which decides which stocks will be there, which stocks need to go out, which stocks need to come in into the Nifty 50. There is a separate committee. That is not our headache. So every 6 months, this changes. Okay. So for example, in September 30th last year, the Nifty 50, what happened? Max Healthcare and Interglobe Aviation, which is Indigo, entered into Nifty 50. IndusInd Bank and Hero MotoCorp were kicked out. Okay. Now this happens in March end and September end. So this is what happened last September end. This is what happened last year's March. Zomato and Jio entered Nifty and Britannia and BPCL exited. March 2026, we did not have a rebalancing because the top 50 after re-evaluation remained the same. Got it? So it is not necessarily that every rebalancing, something or the other will come in. That is usually what happens. But if let's say the top 50 are doing good, right, they will continue to be there itself. Understood? It can always happen, right? Last year, if Ayush, Rahul, and Aditya were the top 3 students, it can so happen that this year also Rahul, Ayush, and Aditya are the top 3 students. It can so happen, right? So again, there is a proper revaluation done every 6 months, March end and September end, right? And then the decision is made. Everybody clear? When does the Nifty 50 rebalancing happen? Again, quick. March end and September end. Now, we know about Nifty 50. We also know about the mutual funds which track Nifty 50. What are those? We just learned it. Index mutual funds. So there are Nifty 50 mutual funds. Every mutual fund company has a Nifty 50 mutual fund. UTI, ICICI, SBI, HDFC, every mutual fund company has a Nifty 50 mutual fund and it is one of their biggest funds. Always. Because there are a lot of people who are passive investors. Right? Now, what do these companies do? They basically mimic Nifty 50, yes or no? These Nifty 50 mutual funds, they mimic Nifty 50. Now, if Nifty 50 rebalances, let's say stock A is removed from Nifty 50 and stock B enters Nifty 50. These copycats will also do the same thing. They will now need to sell stock A and buy stock B. Everybody till here, yes or no? These Nifty 50 mutual funds, they'll need to copycat. Stock A exits Nifty 50. So mutual funds sell stock A. Stock B enters Nifty 50. All these copycats, they will need to buy stock B. Now, basic class 8 mathematics, sorry, economics. Okay. If or everybody wants to buy stock B, what happens to the price of stock B? Should be increasing. Demand goes up, price goes up. Correct? Class 8 economics. If everybody is selling stock A, what happens to the price? Supply goes up, price goes down. Right? Yes, this is what should happen. Now, this is the logic. But if everything is not logical in the markets, we need to check whether this logic is actually functioning in the markets as well. है ना? We need to do a check. Logically sounds good. In practice, is it okay? Can we do something with it? So what is the theory? What would you do? Let's say if you had this logic, what would you try to do with this knowledge? All of you. Open question to all of you. Buy stock A. Correct? Buy stock A. That is the logic. That is what the logic is trying to tell us. That if this actually happens, might be a good opportunity to buy stock A because prices should increase. Correct? Selling. So we are not going into short selling and everything. Let's keep it simple. We will buy stock. There is an opportunity to buy a stock for the stock's price to increase and for us to make profits. That is what we are trying. What is the hypothesis? Do you want to see the back-tested returns? Whether this actually works or not? So the logic is, what we are trying to establish that if, let's say, rebalancing happens, the stock which enters, we buy it, we hold it for a year, and then we sell it. Okay? So let's say March rebalancing happens, 1st of April, we buy it, hold it till next March end, and then sell it. September rebalancing, we buy it on 1st of October, we hold it till next September end, sell it. Rinse and repeat. Correct? No specific quantity, just the idea. Would you like to see the back-tested returns of this framework? To see this logic, do the litmus test of the markets? Well, to understand whether the performance is good or bad, we need to have an anchor. We need to have a benchmark or a comparative figure. So between October 2020 and March 2026, Nifty went up from 11,642 to 22,331. So Nifty gave an average return of 12.57%. Okay. Good or bad? Okay, right? Okay. In the same period, this logic that we just learned and we wanted to test, it has given 29.5%. Good or bad? Right? How many times? 15 trades or 15 investments across this 5.5-year period. 11 were winning, 4 were losing, win rate of 73%, and it outperformed Nifty on an average by 16.93% every year. Now, as I promised to all of you, everything that I teach you, I'll be showing you proper data so that you can cross-verify whether I'm telling you the right thing or not. I showed you exactly this. You can go and check it. I can show you the backtest of this strategy as well. This is exactly when rebalancings happened, what stocks entered, what was the price of the stock when it entered Nifty all the way from March 2020 till today. Okay. This is the price on rebalancing date. This is the price after exactly 1 year. And this is the return. Actually, this should be red. Okay. On average, 29.5, 15 trades, 11 winners, 4 losers, 16.5% above Nifty 50 every year. I'll be sharing this with you. so that you can also keep on maintaining this Excel, and the logic and everything that we just tried to test is over here too. Can I have a happy in the chat if you are happy with the simple framework? Now tell me something. This is active investing, by the way, but does it need you to be active every day or only twice a year? Rebalancing happens twice a year. So you will need to be active twice a year. Now, how will you know which stock is entering the index or right every 6 months? Just follow the news. March end, Google Nifty rebalance, it will tell you. September end, go open Google Nifty rebalance, it will tell you. And I'm not just telling you, logics that can work, right? I'm telling you logics and I'm showing you the proof over here as well. You can cross check each and every rebalance. You can cross check each and every price point as well. I'll be sharing this Excel file and everything else with you by the end of today's session. I will not give it to you right now because I know if I give it to you right now, you will not pay attention to everything else and start playing around with all of this. And you know I am right. So I'll wait and I'll be sharing all of this at 10 o'clock with you today. By the way, again, this is 2 out of 3 strategies. We have AI workflows, we have trading strategies to go. We have a lot more to cover. I think I am going 10 minutes behind. But okay, all of you are understanding. No, that is the most important thing for me. You are understanding. Am I being able to make finance simple for you? Yes? Perfect. All right. So do you think that this was a very smart, logical framework for short-term active investments? All of you can do this. Even if you're somebody who did not know anything about finance before today, you will also be able to do this. Because at the end of the day, what is most important is logic. Okay? Now, active investing, what did we do? We went and took apart Nifty 50 itself. But what about active investing in individual stocks? A lot of you will want to know about this as well. Correct? But there is a problem. There are so many stocks. One question which all of you will be having is how to choose the best growth portfolio. Right? Because there are so many stocks, as we said, 7,000. Well, for growth perspective and for investing, you need something called as a fundamental approach. All of you just use fundamentals when you're screening for stocks and you should be good to go. Okay? Okay? Fundamental use karna hai, that's it. Or was it a bouncer? Fundamental use karna hai, what is he saying? What is fundamental? Well, I was just joking with all of you, of course. Let me explain what are fundamentals, right? So again, fundamentals are basically the pillars of understanding a business, right? So let's say if you go to the doctor and you have an ailment, the doctor will give you tests and you will do different types of tests. You'll get your reports. Like the reports tell you about your health, fundamental analysis tells you about the health of a company. What are the different things which are under the fundamental umbrella? All of you have heard of balance sheet, cash flow statement, income statement, right? So these are what we call as financial statements. Then we have health checks, right? We have financial ratio analysis, efficiency, solvency, all of these things we check. How efficient is the business? Can the business manage its debt? Can the business manage its day-to-day operations? Right? So all of these things we check. And of course, the price. If today you are to buy a business, you will of course try to make sense if you're underpaying for a business, if you're paying the fair amount for a business, or if you're overpaying for a business, right? So again, the other aspect of fundamental analysis is valuation. Okay. So when you combine all of this, understanding the health of a business overall is what we call as fundamental analysis, right? For example, I am a chartered financial analyst and I have learned everything about financial analysis and fundamental analysis from that. Correct? I have worked extensively in this domain to learn how to read financial statements, how to do modeling, how to do valuation. Correct? Can all of you do that? No? Are then how will we go and implement fundamental analysis? Well, don't worry. You don't need to do your CFA. You don't need to do your financial analysis course or anything. But you can use fundamental analysis even without knowing about it. Okay? So, would you like to see a customizable fundamental investing idea? Yes. So, introducing the third framework for today, which is SpringPad's Alpha Plus Investing Screener. Okay? So, here is a screener that I have built for all of you. And over here, you will see a few metrics, right? Somebody is giving the CFA1 exam in August. All the best. All right. So over here, you will see a few fundamental criteria that I've put in, like sales growth, right? Sales growth should be more than 10%. Sales growth over the last 10 years on average should be more than 10%. I don't want the stocks to be a one stock pony or a 1 year pony, right? Return on equity should be more than 15. Average ROC should be greater than 15. Market cap should be at least 10,000 rupees, 10,000 crore rupees. The stock price should be near about less than 15% its peak, and the PEG ratio should be less than 3. Now, to be able to understand all of these ratios, you need to learn, right? But even without learning, you can use these metrics to filter out stocks for you. For example, how many stocks do we have in the market? 7,000. Just by utilizing these few screens, it has filtered all the stocks, all 7,000 stocks, and given me a list of 25 stocks, which meet my fundamental criteria. So, काम हो गया ना? We have arrived at the end outcome. Though we have not learned anything about fundamental analysis, but you can create or use screeners like this. This is something I have created and I'll be sharing it with you. Right? Now, there are 25 stocks. I'll say, Array, I can't go and buy 25 stocks all the time. I want to create a 10 stock portfolio. Correct? 25 is a lot. Sometimes the screen will give you 13 results. Sometimes it will give you 35 results. So you want to keep it simple. Let's say you want to build a 10 stock portfolio. So what you do is you sort by market cap. Okay. Now all these 25 stocks meet my criteria. What I'll do is I'll do a method wherein I take the biggest 10 out of the list. Got it? I take the biggest 10. So if I sort by market cap, that means the biggest company to the lowest company, and I take the top 10. So the top 10 biggest stocks which meet my criteria. Yes. Again, let me show the logic to you over here as well. Run the screener. Take the top 10 stocks by market cap based on the fundamental screen. Hold it for 12 months and then rinse and repeat. Okay? Hold it for 12 months or 1 year. Best thing is to do January to December. It is the most optimal window. Okay? Got it? Would you love to see the result? Yes. Drum rolls. So this is the 2025 backtest because we run it from January to December. So we ran it last year as well. In 2025, it gave 33.85% return. Nifty 50 LTM return was 10.54% in the same year. And the outperformance over Nifty was 23.31%. Good or bad? Good or bad? Very good. But see, this is not the important thing. This is not the most important thing. Some years it will be higher, some years it will be lower. We can never say, right? We can never say. But what is most important is that these weather stocks in 2025, this was the price at the beginning of January. This was the price at the ending of January. This was the 1 year return. One stock, sorry, one stock gave negative returns, which is Angel One. Remaining, I think all 9 out of the 10 gave positive returns. Okay, again, only God can be right 100% time, right? If you are making more wins than losses, you are doing great. That is the only thing that you can try to do in the market to survive and be consistent. Be right more than you are wrong, right? So even this had one wrong. That is absolutely fine. Okay. How did we get this top 10? Same way last year at the beginning of January, ran the screen, right? Sorted by market cap, pick the top 10. Okay. We did the same thing for January as well, but unfortunately, January, the financial year is still not, the calendar year is still not over, right? And also SEBI necessitates us that we can't use stock level data, which is not at least 3 months old, right? By the way, so I can't show you because it will be tantamount to giving recommendations. I can't show you the 2026, but I can definitely give you the screener. Would you like to see how the thing performed in 2024 as well? Yes. 2024, it gave 63.58% return. Nifty in 2024 gave 8%. Outperformance was 54%. So 2024 was, of course, great. 2025, good, not as great. I think 2024 was an exception. This is more natural, right? Again, I hope 2026 is going to be good as well. But yes, all of you understood how we did this, how to use the screener, right? Just open the link. It will screen it for you beginning of the year and take the top 10 by highest market cap. Okay. You don't need to do anything else. Open screener, sort by market cap, take the biggest 10. Right? I'll be sharing the link with you as well. And no, you can use the free version of screener to do this. All right. By the way, again, like with everything else, I told you that I'll be sharing all the data with you so that you can cross check if I'm being honest with you or not. So I'll be sharing this Excel sheet with you as well. So this is the entire summary for 2025. This is the back-tested summary for 2024. You can also, if you intend to use this, you can use the same template for your own tracking as well. Okay. What if we use bottom 10? I don't know. I haven't done it. I tried this method. It worked out great for me and I have been doing the same thing, right? Feel free to try out the bottom 10. Okay. All right. So that was the third framework that I had to show all of you, right? So do you think there's a smart way to filter out fundamentally strong companies with good growth potential without knowing fundamentals at all? Yes. Back-tested results also promising. Of course, there is no guarantee about the future, but all we can do is backtest, try and see if the logic is working, right? And then take the next steps. Okay. Now, so that was the 3 of our 3-2-1 agenda for today. Okay. What was the agenda 2? Let's see how many of you remember. I said I'll teach you market basics like 3-2-1, right? First 3 was done. 3 strategies done. Second was absolutely correct. Now everybody remembers AI assisted market analysis. Before we do that, can we take a small detour? Guys, I am pumped up. I need to show a lot of things to you today, right? If you want a quick break, go, run, come back. Coffee chahiye, go, get your coffee, come back. Want to go to the loo, go, come back. You won't miss out on much. But I can't stop because I have a lot to share. And of course, all of you, you'll be getting the notes at the end of day 4. So that's absolutely fine. If you need a quick 1 minute break, go and take it. Okay? All right. Now, let's take a small detour. All right? Let's play a small game. Everybody, how many of you more or less follow the markets? More or less. Let's see. Me, all right, me. Acha, can you, let's play a game of identifying charts, okay? Those who follow the markets a little bit. Can you guess this stock? It went up 118% in 5 months. Let's see the answers in the chat. If I see the correct answer, I'll stop. Zomato, Oracle, MTAR, Bell, NVIDIA. Are nahi, Indian, Desi, Indian stock. Coforge, Cupid, Bima, TCS, MRF, LNT, CDSL. Okay, chalo, I have got my answer. Can you identify this? The stock gave 587% in 2.5 years. Let's see. Silver, Zepto. Zepto, let the IPO happen. Gold, M&M, Dixon, Cianagro, Tata Power, Tesla. Again, guys, Desi. Trend. Trend to kaha yaar? Okay, but I've got my answer. What about this? Third and last. 642% in 2 years. Titan. Infosys. Infosys kahan se? No. BSC. Laurus. Laurus did good this year. Kalyan. HDFC to nahi. M&M. Suzlon. Starlight. Okay, I've got the answer. Okay, I've got the answer. I'll be revealing the answers. But just a quick question. If you could go back in time, would you have loved to invest in these stocks? Like, of course, yes. What sort of a question is this? Every sane person will, of course, say yes to that. Of course, right? But again, what can be done? Right? We can't go back in time and do this. So the first stock was Gravita India, 118%. The second stock was Zomato, which is Eternal, right? How much would it give? 587%. And the third was Motilal Oswal. I think Motilal Oswal only 1% mentioned, right? Which gave 642% in 2 years' time. Okay. Now, what is the point of going through all this? Anybody, after everything has happened, anybody can go open up a chart and show, array, this has gone up so much. But the real thing is being able to enter in a position like this, or being able to enter in a position like this, or being able to enter in a position like this before the growth happens, right? That is where the real knowledge comes in. That is where you are actually standing to benefit. If you enter over here after the train has, reached the destination, are you going to go anywhere? No, you're going to stay the same place, right? So again, this makes us happy looking at stocks which has grown a lot, but does it do anything for us? No, not really, right? The point we want to do is we want to be able to pick stocks with good probability or high probability potential, right? Growth potential, right? That is exactly what all of us, we would want to do. But we are not professional stock analysts, right? How can we research stocks like institutions with proper analysis? You are majority if you're not stock analysts, you're not working for this in this domain, right? So would you listen to anybody's stock advice? A lot of you do this. If you're somebody who does this, please stop. Random Telegram channels, all of that, please don't do it. I have seen a lot of people burn their money, burn their entire bank account, their trading account, blow it up, listening to all those random stock advices on random Telegram groups. You will not believe how gamified they are. The screenshots that they share with all of you, it's all fudged up. It's all gamified, right? I have had a very close cousin who almost lost close to 18 lakh rupees. Never told me about this because he knew that if he told me that he's a part of some channel, I would have given him a thrashing. He never told me. He told me after he lost a lot of his money, right? Fake YouTube also. Be very, very with your money, right? Because people will come and go. It is your hard earned money. If you lose it, only you lose it, not somebody else is running a Telegram channel. Again, I digress from the topic. Would you listen, or would you, or should you listen to anybody's stock advice? Chacha Mama, if they're not professionally doing this, then no, right? Absolutely no. But what if you could listen to what top institutions whose bread and butter it is to analyze these stocks? Would you listen to them? Like Reliance Securities, Motilal Oswal, Nielsen, Crystal, JM Financial, Kotak Securities, SBI Securities, Nomura, Jeffries. Believe me, I have had the privilege to work in organizations like this, working on the equity research side of the business. And they are the best of best minds enter into this space, and they're very, very smart and diligent, right? So, absolutely, yes, we should definitely pay heed to what they are saying. Correct? But there is one problem. All of them are experts, but there is one problem. Any guesses? Let's see. Cost, no. You can get these for free. Timing, bias, difference in opinion. Absolutely correct. For example, if let's say I'm talking about Swiggy, right? Somebody says, Are Swiggy will go to 500 bucks. Let's say Reliance says Swiggy will go to 500 bucks. Motilal says, no, Swiggy will go down to 150. Nielsen will say, no, Swiggy will go to 300. Nomura says, no, Swiggy will stay where it is at 250. All of them are experts. All of them are right by their own analysis. Everybody is doing their very own detailed analysis and everybody is right by their opinion. But you, as somebody who is trying to heed their advice, you will be confused, right? Because of this difference in opinion. कि सुने तो किसका सुने? Should I listen to Reliance? Should I listen to Motilal? Should I listen to Nomura? Correct? But what if there was a way wherein you can know exactly what the consensus is across this investment research firms on stocks which they think will grow? What if you could get a consensus opinion? Would that make life easier for you? Yes. Well, that brings me to segment number 2. Now, part 2 of our 321, which is AI assisted investment research. That again, it literally feels like cheating. Okay. So I want to introduce you to our first AI workflow, which is SpringPad's professional analyst stock recommendation summary prompt. It's a big name. I need to rework on that, but it does the job. Okay. Let's see how we can put it into practice. So this is Perplexity. All of you would have heard of Perplexity, you would have used it. Let's see if we can use Perplexity to generate a consensus opinion for us. So of course, where there is AI, there is a prompt. We have the prompt over here, which I'll be sharing with you. All you need to do is copy the entire prompt. Okay. It's a 4-page prompt. Copy it, go to Perplexity, paste it, and enter the name of the stock that you want to understand what the institutions are saying about it. For example, let's say I want to look at ICICI Bank. Just change the name of the stock and hit enter. Okay. I have already run the analysis for you. Let me show that to you. I already ran this before the session. So see, same prompt, big prompt. Over here, just a second. Over here, can you see this? Perplexity is very good for research. Web scraping, research, Perplexity is very good at that, right? So Perplexity says that there are 39 analysts, right? What do I mean by analysts? Analysts like this. there are 39 analysts who are covering ICICI Bank. 37 feel that it is a buy recommendation, that is 95%. Who feel that it is a hold recommendation, that is neutral viewpoint on the stock, and 0 feel that it is a sell recommendation, that means there is negative sentiment on the stock. Everybody, this much is understandable. Guys, stop typing in the chat. Tell me whether you understand this or not. Yes? Clear? Now, what will we do with this? Good. Consensus is positive, but what do we do from here? Let's take it a step further. We broke down every analyst's expectation about price, build a probability distribution around it, and then brought down a consensus opinion. All of you have heard of probability distribution? Yes? Mathematics? Trying to collate all of the data and find the consensus? Same thing. See how beautiful it is. Based on all 39 analysts' recommendation, it tells you, where is ICICI at today? Just a second. 1433. Price target above 750, right? 51% probability. 20 analysts say the price will go above 750. 20% 20 analysts, that means 51% probability of a 29.7% upside. This is exactly what I mean by developing a consensus opinion. That means 51% probability based on the analysts of a 30% upside from here in the next 10 months. Now, this is good, right? Rather than going and looking at every individual analyst, this gives me a clear picture that what is it that they are, agreeing on, or what is the common picture. 38% probability of a 16.8% increase. Okay. Now tell me something. All of you know probability, right? All of you know probability. This is from 1550 to 1770, and this is 1770 and above. Can I add these two up and say 51 plus 38? Can I say there is a 99% probability of 16.8% upside or more? Yes? Can I say that? 51% probability? See, the stock which is giving 29% upside, that is giving 16.8 and more, right? That is giving more than 16.8. So, at least 16.8 kitna ho gaya? 38 plus 51, 99. So, 89% probability of a 16.8% up move based on 39 analysts in the next 9 months. Now, this is useful information that I can actually put to practice. Yes or no? You can cross-check all data points, right? That is the best thing about Perplexity. And there is a 10% probability of only a 4.6% increase. But I can take my chances, right? 80, almost 90% probability of 16.8% in the next 9 months, which is a good probability. Everybody, have you learned to interpret the data just like I have taught you? Yes. Let's look at a few other examples. KPIT Technologies. 21 analysts covering. Look at the probability. 19% probability, this is small, of a 74% upside. 48% probability of a 42% upside. How much is 48 plus 19? 67% probability of a 42.1% upside or more. Right? 19, 48, 33. 100% probability as per these analysts of a 13.6% upside in the next 8 months. This is useful information, right? Lemon Tree Hotels. 19 analysts covering Lemon Tree. 32% probability of a 90% up move. 53% probability of a 66% up move. 32 plus 53, guys, 85% probability of a at 66.1 or more up move in the next 12 months. 16% probability of a 23% up move. That means 100% probability of 23.5% or more. Yes. Again, you can use any stock, enter any stock name, and it will give you an analysis like this. Now, last one, Vedanta. 14 analysts, 36% probability of 30.8%, 50% probability of 15.1, 86% probability of 15.1, and there is also a 14% probability that it goes down by 1%. Got it? So this is how you interpret, and you can just enter the name of any stock, copy paste it in Perplexity, and it will give you the answer. Okay? Got it? Yes? Now tell me something. Now can you find stocks with professional insights on your own? Does this feel like cheating? Yes or no? Bechara, all of these analysts are doing all of their hard work, giving out their own opinion, and you are, chodo, I'll take the consensus opinion, I'll use AI. I'll take their hard work and use it for my benefit. Anyways, you want to do another fun exercise? Yes? All right, let's go ahead and do that. Okay. How many of you know these people on your screen? Everybody knows them, right? Yes? The late Rakesh Jhunjhunwala, Radhakishan Damani, Sunil Singhania, Ashish Kacholia, Monish Pabrai, Vijay Kedia, they are the stalwarts of the Indian investing landscape. Like you have heard of Warren Buffett in the West, these are the people that us Indians we look up to as investors, right? So these are the stalwarts of our investing space in India, right? Now, how would you like to know that how has their portfolio performed? Yeah, stalwarts, right? How are they doing? Interesting. Yes, interesting. So, how has their portfolio performed? Let's see how has their portfolio performed between 2013 and 2026. Okay? So, we did the back test. We pulled out all of their holdings every time. Okay? And we saw that across this 13 years, on an average, there were 200 stocks holding across their entire portfolio. There are 2,598 stock periods. Now, what are stock periods? Basically, whenever we have a portfolio which keeps on churning, right? We calculate a period not in terms of years, but in terms of months. So one stock period, so let's say if you are holding one stock for 1.5 years, that is 18 stock periods. Okay. But again, you don't need to know this. So there were almost 2,600 stock periods. The average annual return was 32%. Over 13 years, the average annual return was 32%. The hit rate, how many times the individual stock periods were positive versus negative, hit rate was 64%. And the single best year in this 13-year period, they gave 127% returns, which was in FY21. That means in the COVID year, when everybody was struggling. FY21 matlab, guys, April 2020 to March 2021. Just immediately after the bounce back in COVID, a lot of people, even Prateek sir, me to some extent, right? We made a lot of, we did well as like these investors, because we understood that it was an opportunity. When the markets went down to less sub 10,000 levels, we understood that if it goes, everything, all hell breaks loose, right? What will we do with that money? So with that mindset, Prateek and me, what we did was, Pratik, I remember he emptied his bank account, literally emptied his bank account and put everything in the markets at the bottom. I did not have that much conviction. Correct. I left a little money, invested everything else in the markets, whatever I had. And within a year, it doubled. And then after the COVID recovery, there was a rally as well. So even these people, again, of course, they're very opportunity hungry people. If you see their portfolio, you will find it comprising of small companies because they understand that that is where the growth is, right? So if you see, this is how they have performed across the entire 13 years. Now tell me something, how would it be if you could pick their brains? What are these people buying? When are they buying? Why are they buying? How would that be? That would be awesome, right? Amazing. Feels like thievery, but chalo, if it is public data, why not? So, and you know what? There is a screener which helps you do exactly that. I want to introduce you to, wait a minute. Sorry. Here is a screener. I did not build this screener. Some bhala admi, right, built this on Trendline, which is another platform like screener.ing that I showed you. This person built a screen wherein every quarter, whatever buys these big institutional investors are making, right, it logs it over here. So every quarter, whatever stocks they are buying, right, you will get to know from the screener. But as I said, these people have, hundreds of stocks in their portfolio because that is their full-time job. They have teams of 30, 40, 50 people who are managing their portfolio, right? Can you, as an individual, does it make sense for you to have 100, 200 stocks in your portfolio? You'll get crazy trying to manage all those, trying to keep up with what is happening in which company, because your real job starts after you have invested in a stock. Correct? Because it's like a baby. You need to constantly monitor it, keep your eyes open. Is everything going according to plan? Review it because your money is attached. It's not possible. You are alone. You have a full-time job. You're not doing this full-time as well. But so, for example, last quarter, there were 22 stocks that were bought. Every quarter, if you buy 22, 22, 22, you will get mad. Correct? So, yes, we can see exactly what they are buying. But of course, it is not possible for us to buy each and everything that they're buying. Right? We can't copy. Understood the problem? Understood the beauty of us being able to identify what they're buying? Yet, there is a small problem. And to help you tackle that problem, I have built a prompt for you, which will go through all the stocks in every quarter that these people are buying. And then it will tell you exactly which are the very, very strong contenders that you should be focusing on. How would that be? It will cherry pick even from within the cherry picked data that these people have. That would be amazing. Yes. So here is the prompt. Superstar investors stock pick prompt. Again, from where prompt is written, just below that, copy the entire thing. It's a 10-page prompt. Go to Claude, paste it. Just a second. Paste the prompt. Okay? But you need to give Claude this data as well. What is it that exactly these people have bought in the latest quarter? So all you can do is go here, click on download this table, right? Even in the free version, you can download this. Okay. So download, and when you go to Claude, attach that as well. See, I had already downloaded this today earlier. So I'll attach that. And I will just type run prompt as instructed. That's it. Copy prompt, download this list, attach it and hit enter. How to download file? Just go here, click on export, click on download CSV. Free. You can use the free version of Claude. You can use the free version of Trendline. I'll be sharing this link with you. Would you like to see the output? It takes 10 minutes or so, but would you like to see the output? So see, exactly, prompt, file, run analysis. I ran this before we entered this session today. It builds your analysis for you. See, 30th July.
So
I have downloaded it and made it available. So you can switch modes. It creates a live artifact for you. So over here, look at this. Now I want you to stop typing for 1 minute and let me explain how beautiful the output is to all of you. So it tells you that Nifty in the last quarter has given 0.6% return, whereas most of these, all 22 stocks on average have given 18.4%, more than Nifty. 18 out of 22 have beaten Nifty, 4 have underperformed Nifty, right? Median alpha is 10.9, right? And the mean score is 5.79. Now, what is the mean score? Remember, I said that it will help you cherry pick from even this list. That is what I said. So look at this. This is Nifty. Zero line is Nifty, 0.6%. Anything above is what it has done, right? 97% alpha, 74%, 71, 71. And then these are the ones which have underperformed Nifty. So 18 have overperformed, 4 have underperformed. So we will look at the categorization. Now it has done a scoring. Over here, if you go to screen, you will find all 22 stocks over here. Just a second, all stocks. You will find all 22 stocks over here. Yes, right? Now for each and every stock, it will do a probability, high probability or low probability. We want to avoid low probability. 17 to 22, 6 stocks are low probability stocks. We don't want to put our head over there. We want to put our head into the 16 high probability stocks. There are 16 high probability stocks. Over here, you will see a scoring based on a lot of factors. What is the bull case, net profit, a fundamental analysis? There is no material negative data, right? What is the verdict? What is the scoring? Growth, value, size, data quality, weightage total. And then it creates a combined score, as you can see over here, out of 10. So I have sorted this data basis on score. 7.5. So highest is 7.5. And based on it, it creates tiers in the high probability as well. 16 stocks are high probability. 4 are tier 1. Can you see? Tier 1. Okay? Tier 2, tier 1. Sorry, tier 1, tier 1, tier 1, tier 1. Anything below 7 is tier 2. Okay? Then you have tier 3 as well, which was low probability. Over here, you can see tier 3 is low probability. So we will only focus on high probability. You can also score by alpha, which is how much they have outperformed Nifty, by profit growth, by price to book value, by market cap. It can do so much for you. Then leaderboard. Again, based on the scoring, it will create the leaderboard for you. It will create an actionable summary for you. It will create a red flags, if any. So see all the stocks which are low probability, it tells you exactly why it is low probability. What are the red flags? And what is the methodology? What is alpha? What is growth? How has it arrived at the scoring mechanism? Don't you think that this is absolutely wonderful? Yes. Just go to screen, go to high probability and only take tier 1. See, no material bear case, no red flag, no red flag, no red flag. Why do we want to take risk with anything else? Let them take risk, na? Let them take risk with all 22. They have dedicated teams. They're already super wealthy. They're already billionaires. You can't take risk, na? You can't have 200 stocks. Something like this, an interactive artifact, does it help you? Well, the prompt, yes, the prompt is the magic. It's a 10-page prompt. I have exactly told it how to score, how to rank, all of it. That is why it is a 10-page prompt. But, tell me something. Don't you think methodical investing logics are simple yet wonderful to use? This I'm pretty sure all of you loved, right? Yes. Felt like cheating, but very smart cheating. Yes? All right. Well, why are we doing so much effort? Why are we taking so much effort to teach you this, all of this? Why are you taking so much effort to learn? Because remember, what did we start the session with? We wanted 4 extra percent, right? We wanted to make 4% more. Correct? Well, we are learning all of this because there is one single goal that Prateek sir and I have, and also Aditya, is to democratize financial education for everyone, right? Everyone deserves to achieve their goals, but lack clarity, structure, and of course, when it comes to finance, the know-how to take the steps which are necessary, right? Like a lot of you are learning it fresh today for the first time. But are you having any challenges or are you able to understand things simply? There's a lot of complication which is unnecessarily attached to the stock market because people tend to overcomplicate things, right? And that is why we want to teach you and equip you with all the tools of the trade that will help you on your journey, right? I will definitely, my goal is always to try and simplify concepts. I hope I'm doing that for you. And another thing that I'm doing, which I think few of you will understand, is trying you to focus on returns. I'm not asking you to be greedy, but why am I emphasizing on, active investing, different strategies? Why not passive investing? Why am I chasing returns so much? Why am I emphasizing returns so much? Any guesses? Let's do one thing. All of you, you have seen your mutual fund Sahi Hai calculators, right? Like, for example, this. It always depends on three things: how much money you're putting in, what return are you earning, and how long are you investing for. These are the three pillars on which, okay, the future value of your investments depends. Correct? Everybody aligned with this? These are the three things on which the future value of money depends. Now tell me something. How many of you are salaried and this salary takes care of all your monthly expenses and EMIs? Almost everybody. A few of you are business owners and that business income takes care of your EMIs. Now tell me something. All of you, if I ask you today that are you in a position to invest as much as possible, right? So that you can have a very, very big future value tomorrow. For example, if I ask all of you to put in an extra 10 lakh rupees every month SIP, 10 lakh rupees SIP karo. Very, very big future corpus you'll have. Is it practically possible? No, right? It is very difficult and it is not feasible for most, right? Again, another thing that I want to discuss. Let us be completely honest about this. How many of you feel that you should have started longer back, started operating in the markets longer back, right? Are we on time or are we late in our wealth creation journey? All of you, even I, who started reasonably early, even I feel, arey yaar, if I could have started 5 years earlier. It's a very common phenomenon. But can we go back in time and become young and start earlier? We can't, right? What is the solution? The only solution that we have is to start today, right? Is to start now. So, out of the three factors, two factors are never in our control, is it? Amount of money is actually a constraint. We invest whatever we are left with at the end of the month after meeting our more pressing EMIs and expenses. time, how much we have, can we extend time as much as possible? Invest for 100 years. Nahi hota hai na? It is also a constraint. What is the only thing which is not a constraint? The rate of return. That is why, if possible, the only thing that you should work towards is increasing this as much as possible, because this is the only thing which is in your hands. And that is why, of course, passive investing is great. Everybody can do passive investing. Even I do, but a certain part of my portfolio, right? I do goal-based investing, but for that, I do passive ETFs, mutual funds, and I have set up SIPs for them. But majority of what I do is more active, right? Like a lot of strategies, a few of you have shown you, a few of them I have shown you today. Like that, we have so many more strategies. And that is what I try to do. Trade actively, invest actively, generate potentially higher returns. Of course, it has higher risk than passive investing as well, but it has higher returns, right? That is what I'm going for. And of course, take the effort to rebalance the investments from time to time, capture stocks, be always on the lookout for new opportunities everywhere on a daily basis, right? Now, you must be thinking, how much of a difference, sir, can a few percentage points make? Returns ka to theek hai, it is in our control. But let's say we are able to make only 3-4% extra. We have already seen that earlier. But how much will it make? Let's take the help of maths again. If, let's say, forget SIP, forget everything. If you put 10,000 rupees, invest 10,000 rupees today in a particular stock, and that stock grows at 15%, your 10,000 rupees after 30 years will become 6.6 lakhs. If that stock grows at 25%, your 10,000 will become 80 lakhs. So is it a difference of 10%, or is it a difference of 14 times? You tell me. It's a difference of 14 times. 6.6 versus 80 lakhs. Right? Again, now factor in inflation. 10,000 after inflation at 15% only becomes 58,000 in real value after 30 years. Same 10,000 at 25%, even after 8.4% cost of inflation, still becomes 7.2 lakhs. And the difference again, same, 14 times. Right? So, of course, fighting for each and every additional percentage, does it make sense? Yes or no? Yes. To be able to trade, look for opportunities, full-time, be active. It makes sense. But then I still know that a lot of you will be having this question, but Rahul sir, how can someone trade with a full-time career? I am a doctor, I am a software engineer, I am this, I am that, I have my profession. I am occupied with my work. I can only trade part-time. Can that be enough? How many of you have this question? Part-time ka to chhoro, I'll give you something even more wonderful. Let's do the last fun exercise together. Everybody. Yes. So this is the 3-2-1 ka 1, which is the swing trading setup that you can start using from today itself. Let me introduce you to the concept of FII build-up framework, right? And let's take 2 minutes to understand the concept first. Then we'll see how to trade on it. Okay? Okay? You all know that a company has shareholders. If you buy a share of Reliance today, you become a shareholder of Reliance. So each and every stock has shareholders. There are 4 different categories of shareholders. There are promoters, right? People who originally built the company. There are institutions. Now, institutions are of 2 types. There are foreign institutions based abroad who are putting in money in our Indian stocks. There are Indian institutions who put money in Indian stocks, right? And then, of course, there are public or retailers like you and me who buy these stocks. So there are 4 different kinds of company shareholders. As the name suggests, we will be focusing on the foreign institutional investors, which is our strategy, right? Now tell me something. If a company has a good amount, right, or a good chunk or share of its shareholding held by these foreign institutions, is it a good sign or a bad sign for the company? Good, bad, good, good. Don't confuse it with trading, right? I'm saying shareholding, that means investments. Foreign money is being invested in these shares. It's a good sign because these foreign institutions can go to, let's say, China, can go to Hong Kong, can go to Singapore, can go to any Japan if they want to invest their money. If that is that too, I'm speaking about the uh, Asian subcontinent, right? They can also go to any place else. But basis of all their analysis, if they see that there is value in a particular stock and they're putting their money here, it is of course gives you a higher sense of conviction. Yes or no? Yes. Domestic institutions will to put money. They are foregoing even more options to put money over here. So it's a good sign. Now, next question. If let's say FII holding increases from one quarter to the next quarter, is that good or bad? Same logic, even better. That means FIIs are expecting more growth. Now, the good thing is that every quarter, the companies are required to make this public knowledge. Every quarter, companies release their earnings report, their press release, and with that, they release these data points as well. That how much of their stock is with, held by what sort of shareholder. Now, do you think in your wildest of dreams, you can take this very public knowledge and put it to your practice? Anybody with a smartphone and an internet connection can have this data on any company. Everybody has access. The question answer is yes. Remember, equal weighted Nifty portfolios have always existed and have always outperformed, but you did not know about it. Information is there. We don't know what to look for. So let's see if we can build a logic based on this. Now, because I want movement, fast movement, we want to trade, right? So we want fast movement. We don't want to hold a stock for 5 years, right? We want to trade. We want fast movement. Fast movement usually does not happen, in the Nifty 50 or the very large cap space. Large caps take time because they're already very big. So we will look at the mid cap 100. So if we rank all the stocks from 1 to 7,000, top 50, Nifty 50, 101 to 200 is what we call as the mid cap 100 space, right? Our job, our logic is, let us look at the mid cap 100 stocks and let us see that whenever they release quarterly earnings, is the FII holding increasing by more than 3%? Remember, we said FII holding is good. FII holding increasing is very good. So let's see which are the stocks in this Nifty mid-cap 100 space which are increasing their FII holding by more than 3% every quarter. If we find a stock the next day, right, let's say earnings are released, we see that yes, FII holding more than 3% increase. Next day, the logic is we go and buy when the markets open, hold it for 3 months, and then sell it. Now, to be able to do this, we need to constantly monitor all the 100 stocks in the Nifty mid-cap 100 space. Correct? So every day, we need to do this. We need to check whether any of the Nifty mid-cap 100 stocks have released their earnings. And if yes, is the FII holding more than 3% increase? Okay? 3 months, good enough for a swing trade. Right? Good enough for a positional trade because we want to trade. We don't want to invest. There's a trading strategy. There's a swing trading strategy. It's very, very simple. Now, how many of you are sad that every day you need to check all 100 companies? बहुत time lag jayega, Rahul sir was telling it is possible. Not too much effort. This looks like a lot of effort. Well, there is a screener which I have built. Okay. This already knows what are the mid cap 100 stocks. Okay. Let me put it to live screen. Already will only look at the Nifty mid cap 100 stock. We'll see if any earnings is being released. And if an earning is being released, it will tell you exactly which stock has more than 53% increase in FII holding. Okay. All you need to do is every day, just open the screener and see if there is a new stock which has entered the list. Got it? How do you track if any company is releasing its earnings and the FII holding is more than 3%? Open this link every day. It will take you half a second. See if any new name is there. If you see a new name, that means earnings was released today and it meets your criteria. And if that happens, if you see a new name next day, 9:30, enter, hold for 3 months, exit. Everybody clear with the logic? Clear with the logic? Very, very simple. I'll be sharing the screener with you. Do you want to see the backtested results of this framework? Absolutely yes. Well, the 3-month average return is 5.5%. How much? So if you're making 5.5% in 3 months, how much does it become in a year? 22%. The actual figure is 21.9. Understood? So I'll be sharing the backtested data with you as well so that you can again cross-check the data, or just you maintain this sheet if you are using it. These are the list of stocks, right, which met the criteria, kept on meeting the criteria. Right. This is the entry, the quarterly result period. This is the price at entry. Remember 9:15 morning. And this is the price after 3 months. Okay. Average 3-month return is 5.48. Annualized return is 21.93. How to know new company? As I said, just open the screener. For example, today it is showing Lenskart Grow and MCX. Now, you don't know whether the earnings have been released today or 2 weeks back. Even if it is 2 weeks back, it'll still keep on showing this. What you need to do is, let's say tomorrow, I open this again and there is a 4th entry, right? Company X. That means if tomorrow there is a new entry, Company X must have recently released its earnings on that very same day, and the FII holding would have been more than 3%. Got it? So all you need to do is open the link every day, see if there is a new stock or not. If there is a new stock, that means there is an opportunity for you on the next day. By the way, the exact logic, screener link and everything is mentioned over here in the Excel sheet that I'll be sharing with you as well. Got it? When to exit? Again, people are not paying attention. It seems it's already late. Is that why? What did I say? What did I say? 3 months. Correct? All right. So tell me, is it something which is very difficult? Every quarter, let's say monthly, you will get hardly 1 or 2 times that you see an entry. That's it. Does it require you to be active a lot? Not at all. You can spare half a minute to open the link and see, right? Half a minute so everybody has. If there is a new stock, only then you need to make an effort. Now, of course, again, I'll repeat, these are, in the markets, of course, we have put everything out there for you. There is no assurance. I hope all of you understand that this will give 21.9% every year. It can be more, it can be less. But the best thing that we can do is see what is working and try to make it work, right? That is exactly what we have done for you as well. So yes, all of you who were thinking, Nay, if I want to trade and invest, I need to do it every day. It's a very, very common misconception that trading requires constant daily time requirement during market hours. And yes, it is possible to trade and invest alongside your career. What do you need? Knowledge, patience, and discipline. I gave you the knowledge. Whatever I have taught you today, does anything require a lot of time? Strategy number one, equal SIP. One time setup, no effort after that. Number two, rebalance, only twice a year. Number three, what was it? Let's see. Alpha Plus investing screener, once a year, right? AI workflows. Again, you can use them whenever you want. And the last one is just half a minute every day. All right. Now, the funny thing is, a lot of people are scared of trading because a lot of people told me at the beginning of the session, I'm a passive investor. Why? Because of this data point. Yes or no? This has been in the news a lot. According to SEBI, 90% people make losses in option trading, 10% make profits. But we have every Tom, Dick, and Harry trying to trade without knowing what it is. You can't be hopeful when it comes to execution. कि market में पैसा डाला पैसा बन जाएगा. Doesn't happen, right? What I have taught you today, is it strategic or is it random? Is it methodical or is it random? It is strategic. It is tried and tested. It is not random. Correct? So what we should focus on is, yet, yes, there will always be people in this 90% bracket, right? Majority of the people treat the markets like a gambling instrument. What we should focus on is what the 10% is doing right. Glass half full versus glass half empty, right? I want to focus on the 10%. What is it that the 10% of traders are doing differently that it is making them profitable, right? A few things that they always do, good, successful, consistent traders always do, is have their own trading strategies. Everything is strategic. No reliance on others, no guesswork, reliance on proper systems and protocols, have rules and execution discipline, right? Which they use to filter stocks, how to execute trades, right? And of course, have a very, very, very strong risk management system. Remember, you can be a trader only as long as you have money. Yes or no? So when you try to trade, what is the most important thing that you should do? Not try and make money. Try to protect your money. If you are able to protect your money while actively trading, returns will automatically follow. That should be your first priority. Never lose your capital. Correct? Intraday trading too. Array, day one of FFA. Of intraday trading, options trading, if I teach you in day one, what will I do for the next 3 days? Anyways, jokes apart. So again, I wanted to give you a glimpse of trading, right? This was swing trading or positional trading is a very long trade that you take. That is what I showed you today. But I want to give you a glimpse of what rule-based trading actually means. Something which is more, frequent, something which you can do, let's say, on a daily time frame, right? Would you like to see? Would you like to get a glimpse? This is how trading with rules actually works. So for example, let's say if I only look at NSE, there are 2,671 stocks. You can't go through all stocks to see which one can I trade on today. So like I showed you in the screeners, which helps us filter, right? Similarly, you use execution logics and rules in trading to help you filter. You, let's say, use one rule that filters down to 58. Add another rule. Add layers. It filters down to 11. Add another layer. It filters down to 3. Can you look at 3 stocks in a day? Yes, you can. So this is how it looks like. One rule, the list becomes smaller. Second rule, even smaller. Third rule, even smaller, right? And the better news is that even when it comes to the final few picks, right, you can still automate this entire process and put it on autopilot. Now, does that sound awesome? That is what is strategic, methodological, risk rule based, and risk managed trading is all about. And that is exactly what we are going to learn in the day two of our FFA program tomorrow. We are going to learn all about, the secret framework that is given approximately 30% CAGR in backtested returns. Pratik sir is going to teach you all about that. You will learn how professional traders use a little known layering concept to exponentially increase the return probability. You will learn how you can trade alongside with your job using the peak framework. You'll learn how to build a no code rule based trading system, and you will also uncover the untold truth of the stock markets, which very few people talk about. We will be discussing that with you. And of course, we will be having the biggest surprise for passionate learners from us and attendance towards the end. So, of course, goes without saying, all of you will be seeing you at 7 p.m. tomorrow. But before that, yes, I remember I need to give you all the materials for today. Before I give you the materials and take your attendance, it is compulsory to mark your attendance, by the way, right? So before I do that, shall I do a quick recap of everything that I have taught you today? Yes. So let me quickly take you through the day one summary. We have learned about the magic of prepayment from Aditya. We have learned about the importance of asset allocation. We have learned about the different asset classes and inflation, learned about diversification using a very practical research that was done, learned the first of the three strategies, the Nifty EQ SIP, learned the rebalance strategy, learned the Alpha Plus screener strategy, learned how to use AI for the probability distribution recommendation, and also to filter down on how the superstars are adding to their portfolio. We also learned about how to get into the right mindset for returns and trading. We saw how a 15% versus a 25% CAGR difference looks like. Was it just a 10% increase? Let me see. It was a 14 time increase, right? So that is why fight for each and every percentage return. Last, we've learned about the uh, trading strategy, which is a swing trading strategy, which is the FIA build-up framework. And last but not the least, I gave you a glimpse of the rule-based trading system, which you're going to learn more about tomorrow. Okay. Now, before I give you the resources, I want to give you something which will be very, very sad to see, which is homework. All right. Don't worry, it will not take more than 10 minutes of your time. Okay. I have a little bit of a homework for you. The first is use the smart EMI calculator, which Aditya, showed all of you. Use it to see if you're somebody who has a loan running, right? How you can use prepayment to your advantage and see how many months you can save and also how much money you can save in the form of interest, time, and money. I have shared the link in the chat. Just use it and let me know tomorrow. The second homework is learn about return on investment or return on expenses rather using credit cards and apply for a credit card of your choice. How many of you use credit cards strategically for rewards? Anybody? That's a lot of people. I started doing this 3 years back and I'm absolutely in love with it. Yes. A lot of you. So if you don't know about this, go YouTube. There are a lot of good content creators. Of course, a few of them will try to sell their own cards to you. But in general, this is something that you can definitely look at. See, there are a few expenses that we have to do every month as it is, be it shopping, utilities, rent, groceries, all of that. Travel, you're going to incur those expenses nonetheless. Fuel. But if you put it on the right credit card, you can generate anywhere between 5 to 25% cashback or rewards for yourself. Correct? So learn a little bit about that. And if you find a good option, try and apply for a credit card of your choice. But do your research. And the last thing is read at least one money control news article and come to the session tomorrow. I don't care which article, just read one article from money control and come. Okay? Got it? So this very simple 3 homeworks for you. We'll be kicking start tomorrow's session with this. Now, having said that, we are already 7 minutes late. Let me quickly take your attendance and then I'll be giving the resources to you. All of you, you can scan this QR code and fill in the form to mark your attendance, right? The team has also shared the link in the chat. This is how your attendance form looks like, okay? Enter your full name, your email address, your phone number, what is your age, how many years of training experience do you have. If you're somebody who's new, click on this. 1 to 2 years, click accordingly, right? What is your monthly income right now? Put in that. How was your experience on the Financial Freedom Accelerator day 1? So tell us what you like. Okay, here's the QR code, guys. Tell us what you like. What is your experience? Let's say you liked the use of AI, or let's say you liked the use of some strategy. Anything, whatever you liked, I would really love to know what is it that you like the most. Correct? And then, of course, if you intend to start, working in the markets, trading, investing, what is your goal from the stock market in the next 1 year? What do you intend to start plan for yourself? And last but not the least, if you like the first day of the FFA, and if given the opportunity that you want to continue your knowledge, education in the financial space further, would you potentially love to learn from us? If that is something, then we can start working towards it as well. So please fill out the form. Here's a QR code again. The team has shared the attendance form in the chat. Guys, again, I'll repeat, it is absolutely mandatory to mark your attendance by filling out the form. Okay? Can I have a quick done in the chat? Done? Perfect. Anybody waiting? Done. I'll just quickly wait for another 30 seconds for all of you to mark your attendance, and then I'll be sharing the resources with you. Done. Perfect. All right. Perfect. Okay. So thank you, everybody. And so this is the resources for everything that I've shown you in day 1. You can scan this QR code or click on the FFA day 1 resources link that the team has shared in the chat right now. This is how the link opens up. You have this day 1 resources. Remember, I told you how on average the superstars generated 33% return. The entire back-tested data is over here. The current data dump that we took from here, right? It is here. I have given it so that you don't need to open it up yourself. And all the strategies and Excel sheets and prompts, everything is in this PDF. Okay. So this is how you use it. If you open the QR code, scan the QR code or click on the link, it is going to open this drive link for you and you can access the resources accordingly. Okay. So PPT, so we won't be sharing the recording, right? PPT and notes we will be sharing to everybody who are marking their attendance at the end of day 4. Like I took your session today, the team will be sitting down and preparing the entire PPT and notes to share with all of you. The team will do the same thing for day 2, day 3 and day 4. And at the end of day 4, they will culminate everything and share it with you. That is why I'm saying it is mandatory to mark your attendance so that the team knows whoever is attending on a daily basis and they'll be sharing it accordingly to all of you. Okay? Notes at the end of day 4. All right. Before uh, I take your leave. I need to ask you one thing. Okay? How was your experience on day one of the FFA? And I'll take a quick recording of my chat so that you all can see what you had to